All right, guys, so remember that the goal of Fannie Mae and Freddie Mac is to help Americans attain home ownership at the most affordable rates they can possibly help people out with. That's like their main goal. Second goal right now is to help as many people get into houses as possible. So they've made some rule changes, some pricing changes to implement this, this second main goal that they have. And these changes have pretty much gone into effect at every mortgage company across the country. The way they're doing that is by pricing, and the way they come up with pricing, which is basically passed on to you, is with these things called loan level pricing adjustments, LLPAs for short. Okay, so let's say, for example, you got a condo, which they consider a little bit riskier than a townhouse or single family. Well, they'll increase your rate by 1/8%. Let's say you have a 670 credit score. Oh, well, then they'll increase your interest rate by 1/4%. Oh, let's say then you have this combination of you're only doing 5% down and you have a 670 credit score. Increase the interest rate by another 1/8% again for that combination. So that's kind of how it works. It's just like with car insurance too. So car insurance for if somebody's super young, they have a poor driving record, they have all these extra factors that make it more risky to give insurance to you, then they're going to keep on increasing that insurance premium. So one of the things they're doing right now, one of the big, huge changes right now is they're changing the credit buckets. I've done this for over 6 years. Every time I've had a conversation with a buyer that's doing a Fannie Mae, Freddie Mac, FHA, VA loan, I've told them, look, once you go 740 and above on the credit score, you can't get any better of an interest rate. That's like the perfect interest rate. Well, now they're adding on buckets on top of that. So it's going to be 780 now to get the best interest rate. So credit is determined in 20-point tiers. So if you have a credit score from 620 to 639, you get a certain interest rate for whatever scenario you're in. And then above that, then the next improvement would be if you had a credit score from 640 to 659, all the way up until, now there's a 740 to 759 credit tier. So that's the third best tier. Now the second best tier is going to be 760 to 779. And then the best credit tier is going to be 780 plus. So that's the first big thing that they're doing. Number two, here's really the biggest change of what they're doing this year. If you're getting a loan and at least one of you guys on the loan is a first-time buyer, now remember, first-time buyer is just somebody who hasn't owned property in the last 3 years. So if you've owned a property like 5 years ago, it's okay. You're going to buy a new house now. You're considered a first-time buyer once again. But if there's at least a first-time buyer going on that loan and you make 100% of the area median income or less, then you get to waive all of these loan level pricing adjustments. Like I was talking about earlier, condo gets you 1/8% higher interest rate and so on and so forth. So you get to basically waive these things if you're a first-time buyer and you're making less than the area median income. And then if you live in a high cost area, if you're making 120% of the income level or below, then you get to waive those. So high cost areas are like in the big cities. The way you figure out what that income limit is for your area is Fannie Mae has this website where you type in the property address and it tells you what the income limit is for that county. So this is going to be fantastic for people that have lower credit, having a low down payment, they're getting into a condo. I saw an example last week. He was a first-time buyer and he was under the area median income limit. His interest rate went down from 7.125 to 5.875. That was huge. And on a $500,000 loan amount, that's going to take your monthly principal and interest payment down from about $3,300 and change to $2,900 and change. It's almost like a $400 decrease. So big stuff for first-time buyers. They're really winning with this. And then a side note, you don't have to be a first-time buyer to qualify for the Home Ready or Home Possible interest rate incentive. If you're under 80% of the area median income limit, you can even have one other home. You can still then qualify for the Home Ready and Home Possible loan level pricing adjustment waivers. A couple other notes on this. If your salary is, let's say, 110K and your bonus is 150K every year, you don't have to use that bonus if you want to try and stay under that area median income limit to get the better interest rate. So you don't have to use a bonus, overtime, or commission if you qualify just with your base salary or wage without it. Second thing here is low down payment, interest rate, and pricing packages that you're going to be getting are going to be a lot better in these situations if you're a first-time buyer and you qualify. Number 3, cash out refinances are going to be made to be a little bit more expensive. If I quote your rate, it's not that sexy, and it's decently far off from the purchase interest rate, then don't be surprised. This is, again, really just being passed on to us. Fourth thing I want to tell you is maybe once you get down to like 40% down on a conventional conforming loan, will it then kill some of those loan level pricing adjustments that you'd be stuck with if you didn't qualify for this new pricing incentive? And I say that because when you have a really large down payment, then it's not as much of a risk to the lender to give you a loan, because if you have to sell a property off in distress, or they foreclose on the house on you, and there's going to be plenty of room there for them to be able to pay for the costs that are going to be involved in selling off that home. Much less chance of there being a short sale in the future, almost none if you have a really big down payment. Kind of final note here is that there is then going to be a small pricing increase if you have a debt to income ratio over 40%. It's small, but the Mortgage Bankers Association apparently, from what I heard, wants to fight this because they think it's going to be a disaster after underwriting debt to income ratios go up sometimes, because really only once the full loan file goes to the underwriter and they're the Wizard of Oz and they figure out what your final debt to income ratio is, we'll then see if that's over 40%. So we're not implementing that yet here at Movement. We don't really plan to yet. It's only a possibility for us, but let's still imagine that would then somehow have to reverberate into the mortgage pricing somehow. But in summary, this could make FHA a much more appealing choice for repeat buyers, because for repeat buyers, their conventional conforming pricing is going to be going up in a lot of cases. And then the conventional conforming pricing and products are going to be more appealing for the first-time buyers. And it's going to give them less of an incentive to then take FHA. What we're really seeing from all this is Fannie Mae and Freddie Mac subsidizing home ownership for the first-timers, which really is at the expense of the repeat buyers. And one small note here is that FHA, yes, they are decreasing the mortgage insurance for most first-time buyers. So that's one thing that's good for FHA. They didn't get hit with all these changes, but for the first-time buyers, they do get a little reprieve on that over there. So, guys, pricing is complicated. A lot of different variables go into pricing out a rate. It just got a little bit more complicated, but you tell me if you think that's fair or not. Tell me if you like it. Tell me what you think. Leave a response in the comments, and thank you for watching the video.